Welcome to the Deep Dives, your direct line for understanding what really happened and what's next after an earnings call.
Hello there.
Today we're taking a close look at Applied Industrial Technologies, or AIT. Specifically, their fiscal year 2025 fourth quarter earnings call. It happened on August 14th, 2025.
And this one's interesting because, well, the immediate market reaction was definitely noteworthy.
It really was. AIT reported some genuinely solid financial beats, but the stock took a significant dip right away in pre-market trading. It set kind of a cautious tone.
Exactly. So our mission today is really to unpack those numbers, try to understand management's perspective on the market, their strategy,
and figure out why investors seemed, well, maybe a bit skeptical despite the good results. And what that all means for AIT and maybe the wider industrial landscape. It feels like a bit of a puzzle.
It does. It's often the case, isn't it? Headline numbers look great, but the market's reading something else between the lines, maybe looking ahead.
Absolutely. So let's lay out those Q4 financial highlights first, because on paper, AIT really did deliver.
They certainly did.
Their GAAP EPS came in at $2.80. That beat consensus estimates by pretty healthy 5 to 6%.
Which is a solid beat, yeah.
And revenue hit about $1.22 billion, also beating the $1.18 billion consensus. That's a 5.5% year-over-year sales increase.
Right. And importantly, organic daily sales, they returned to modest positive growth, just over 0.2% year-over-year for the consolidated business, a definite improvement from the last quarter.
Okay, and you flagged something pretty remarkable before we started. The gross margin.
Yeah, this is quite something. Gross margin expanded to between 30.6% and 30.7%. They actually crossed that 30% threshold for the first time in the company's history.
Wow, over 30% for an industrial distributor.
Yeah.
Yeah, that's impressive. Signals real efficiency or pricing power, doesn't it?
It really does. And then you look at free cash flow. Hit a record $465 million for the full fiscal year. That's up, 34% year over year. Just shows robust cash generation.
Okay. Any other key numbers from the quarter?
Well, EBITDA was around $153 million. That was actually down slightly, 0.3% year over year, giving an EBITDA margin of 12.5%. So a slight dip there.
Right. So putting it all together, strong beats on EPS, revenue, record cash flow, record gross margins. You'd think investors would be cheering.
Right. You would absolutely expect that. But no, that wasn't the reaction at all.
What happened then?
Well, despite these really strong numbers, the market reacted with, let's say, significant caution. The stock dropped about 3.9% to 4.2% in pre-market trading.
So an immediate sell-off.
Yeah, signaling quite a bit of investor skepticism. And it clearly wasn't about the Q4 performance they just reported. It was focused squarely on the forward-looking guidance and, perceived macroeconomic risks.
So the rear view mirror looked great, but the windshield view, maybe not so clear.
That's a perfect way to put it. Investors are definitely more worried about the road ahead.
Okay, so that brings us to the core of our deep dives then. Why the disconnect? Let's start unpacking the performance for the whole fiscal year 2025 first. Because it wasn't just Q4, right? The full year was strong too.
Absolutely. For the full fiscal year 2025, AIT hit new records for sales, EBITDA, and EPS. And that full year EPS growth, 4%, actually beat the high end of their own initial guidance.
That's a really strong result, especially considering the, mixed economic backdrop they were operating in.
It is, and it speaks to their execution. Gross margins for the full year expanded nearly 50 basis points, so 0.5%, and like we said, crossed 30% for the first time annually.
And management highlighted their track record too, didn't they?
They did. They emphasized operating resiliency and value creation potential. They pointed to the last 5 years, showing compounded annual growth for EBITDA of 14% and EPS of 22%. That's pretty stellar.
And margin expansion over that time too.
Yep. Gross and EBITDA margins expanded 130 and 330 basis points respectively over that 5-year period. So it shows this isn't just a one-off good year. It's a pattern of solid execution.
Okay, let's zoom back into Q4 specifically. What were the operational highlights? You mentioned sales beat guidance.
Right. Q4 sales were 2.5% above the high end of their guidance, and average daily sales jumped 4% sequentially from Q3 to Q4.
And that sequential jump was unusual.
It was. It was actually ahead of normal seasonal patterns, which hadn't happened for, I think, 10 quarters. So that might suggest, some underlying demand strength starting to emerge.
Interesting. Okay, let's get into the segments. Engineered Solutions, the ES segment. That showed a turnaround, right?
A big one. First organic year-over-year growth in 7 quarters, up 1.8%. And this is really where you see their strategy playing out.
How so? What drove that growth?
It was significantly driven by double-digit organic growth in their technology vertical. Think data centers, semiconductor manufacturing, really high growth areas, plus mid-single-digit growth in their automation platform.
So hitting those key modern industrial themes, what about orders?
Orders in ES were up high single digits year over year. And encouragingly, that included positive growth in industrial and mobile OEM fluid power orders. That's good news after some real headwinds there.
Okay, but the margin in ES was down a bit.
It was. EBITDA margin was 14.8%, down about 90 basis points year over year. Two main reasons. They were comparing against a really strong quarter last year, and importantly, the impact of the Hydradyne acquisition.
Yes, Hydradyne. That brought a slightly lower margin profile initially.
Exactly. It represented about a 60 basis point headwind to the ES segment margin in the quarter. Strategically vital, but a bit dilutive to margins in the short term.
Got it. So ES is a bright spot overall, showing that strategic shift. What about the more traditional side, the service center segment? How did that fare?
Trends there were actually pretty encouraging, too. Like ES, they exceeded normal seasonal patterns. That was for the second straight quarter. And they even got back to positive organic growth in the month of June.
But for the quarter overall?
For the full quarter, organic daily sales were down slightly, just 0.4% year over year, so almost flat.
Okay. And what about margins in the service centers? Any pressure there?
Yes, there was. Segment margins took a hit from a couple of things. One was higher than expected accounts receivable, or AR provisioning, basically setting aside more for potentially troublesome receivables.
How big an impact was that?
It was an unfavorable $4 million impact, or about 2% year over year on the margin. Then there was also a LIFO expense of $2.9 million.
LIFO. That's the inventory accounting thing.
Right. Last in, first out. It's a non-cash charge related to inventory costs, tends to go up with inflation. So those two things, plus some higher deferred compensation costs, held back the service center EBITDA margins.
So management says the AR provisioning is just timing related. They expect it to normalize.
That's their view, yes. They pointed to the fact that their day sales outstanding, or DSO, how quickly they collect cash, those trends remain favorable. So they don't see it as a sign of widespread credit issues.
But the market might be reading it differently. Seeing that AR number and the LIFO hit and getting nervous about underlying health or maybe broader credit conditions.
That's very likely part of the caution we saw. Management's confidence seems based on those stable DSO trends, suggesting it's maybe more conservatism than actual defaults. The LIFO bit is more accounting noise, but, it's definitely something the market is scrutinizing. If management's right, these are temporary pressures and the underlying trends are okay. It definitely bears watching, though.
Right, that difference between temporary noise and a real shift is crucial. Okay, let's talk acquisitions and capital deployment. Hydradyne was a big one.
Their largest deal in 6 years. It contributed over $7 million in EBITDA in Q4 alone, and they said it's on track to add $0.15 to EPS in its first 12 months.
And the integration. Synergies.
Happening faster than planned, apparently.
Yeah.
Both cost savings and cross-selling opportunities. They mentioned specifically the Southeast region and key growth areas like data centers where Hydradyne strengthens their offering.
Any other M&A impact?
Yeah, there was also an initial contribution from Iris Factory Automation, which they bought in early May.
And all this was funded by?
That record free cash flow we mentioned, $465 million for the year, up 34%. That allowed them to deploy over $560 million in total during fiscal 25.
Wow. So M&A and what else?
Share buybacks, they repurchased 656,000 shares for $153 million. That helps boost EPS.
And dividends.
A big increase there, too. They raised the quarterly dividend by 24%, so clearly showing confidence and returning cash to shareholders alongside growth investments. It's a strong capital allocation story.
Definitely sounds like it. What about managing pricing and inflation? Always a hot topic for industrials.
They seem confident. Product pricing added over 100 basis points, so 1 full percent, to sales growth in Q4.
So they are getting price increases to stick.
Yeah. It seems so. Management expressed high confidence in managing inflation and any tariff issues. They noted they don't source that much directly from outside the U.S., and they pointed to structural mix shifts, selling more higher value stuff, and their own internal initiatives to protect gross margins. Sound like they have multiple levers to pull.
Okay, so that sets the stage pretty well. Strong year. Strong quarter operationally, active capital deployment, managing inflation. Now let's get to the outlook for fiscal year 2026. This is where the market seemed to hesitate.
Precisely. Management themselves called it a prudent initial outlook, citing the ongoing economic uncertainty.
What are the headline numbers for the guidance?
Total sales growth projected at positive 4% to 7%. Within that, organic sales growth is guided between plus 1% and plus 4%.
Okay, so positive, but maybe not explosive growth baked in.
Right. Although there was an encouraging tidbit. They mentioned that early Q1 fiscal 26 organic sales, so basically July and early August, were actually running up about 4% year to date.
Oh, interesting. So already tracking at the high end of the full year organic guide.
Seems like it. A positive early signal that maybe contradicts some of that market pessimism.
Okay. What about earnings and margins in the guide?
EPS guidance is set between $10 and $10.75. EBITDA margin expected between 12.2% and 12.5%. So maybe slightly down from the recent Q4 level at the midpoint.
And pricing, are they expecting that to continue helping?
Yes, significantly. They expect pricing to ramp up and contribute about 150 to 200 basis points to sales growth in FY26. That's 1.5% to 2%.
And the impact of acquisitions already done.
That's expected to add about 300 basis points or 3% total sales growth for the year, but it'll be front-loaded, adding 600 basis points in the first half because of the full impact of Hydradyne coming online. Shows how important that deal is to the near-term growth profile.
Got it. Any other headwinds factored into the guidance? That LIFO expense again?
Yep, LIFO is projected at $14 million to $18 million for the year. Another one of those accounting factors that can obscure the underlying operational picture a bit.
And cash flow. Still strong.
Expected to remain strong, yes, but potentially could be lower than the record FY25 level. They suggested that might be due to needing more working capital if demand picks up and they invest in growth opportunities.
Okay. And when do they expect margins to look better year over year?
They guided for stronger relative year-over-year EBITDA margin trends in the second half of fiscal 26. They pointed to easier comparisons, leveraging expenses better, continued Hydradyne synergies kicking in.
And importantly, this guidance doesn't assume any new deals or buybacks.
Correct. No contribution from future M&A or share repurchases is baked in, so there's potential upside there if they continue to be active, which they signaled they intend to be.
Okay, let's widen the lens again, the broader industrial backdrop. Still pretty mixed out there.
Definitely. Management acknowledged ongoing uncertainty tied to the U.S. election, interest rates, potential trade policy shifts. That's weighing on things.
Where are they seeing weakness specifically?
They mentioned continued declines in several key markets: machinery, primary metals, utility and energy aggregates, chemicals. Also persistent weakness in those off-highway mobile OEM sectors.
But there are offsetting strengths, right? Tying back to that engineered solutions growth.
Exactly. This is the crucial part of their story. They're seeing a significant resurgence in those high-growth tech and automation verticals, data centers, semiconductors, new process infrastructure, advanced robotics.
Driven by bigger trends.
Yes, secular tailwinds like reshoring, companies needing more technical service for older equipment, and just the general expansion of industrial infrastructure in North America.
So management sounds somewhat optimistic longer term.
They do. They anticipate a, quote, productive demand environment developing once there's more policy clarity. They mention recent U.S. trade agreements and potential tax reform as potential positives. And sort of on the ground level, they noted break-fix MRO activity is slowly picking up in the service centers, and project activity in process flow markets got stronger towards the end of Q4.
It really sounds like a tale of two industrial markets. And AIT is deliberately positioning itself in the faster-growing, more tech-focused one.
That's the strategic narrative in a nutshell. They are actively evolving from being just a traditional industrial distributor to more of a technical solutions partner.
Using M&A, focusing on digital and automation demand.
Right. To offset the slower growth and volatility in the traditional M&A distribution side, it's a clear strategic shift aimed at multi-year margin expansion and value creation. But of course, it depends on the macro stabilizing somewhat and them continuing to integrate these acquisitions successfully.
And their long-term vision reflects this.
Very clearly. They're aiming for double-digit compounded earnings and dividend growth, supported by what they call their compounding cash generation algorithm, and a strong balance sheet, giving them capacity for more M&A, buybacks, and dividend hikes. It's a roadmap for moving up the value chain.
Okay. So bringing it back to the investor context, the market's initial negative reaction really zeroed in on that cautious guidance, didn't it?
It absolutely did. It highlights this fixation on perceived near-term risks, the margin pressures from AR and LIFO, the slight softness in service centers, maybe overlooking the bigger strategic picture.
Classic short-term focus versus long-term transformation story.
You could definitely frame it that way. Management's cautious optimism, though, isn't just talk. It seems rooted in that operational resilience, the strong start to Q1 organic sales, the faster than expected Hydradyne synergies, and the planned pricing ramp up.
And that evolving business mix, that pivot to the higher growth, higher margin engineered solutions, that's really the core of the long-term bull case, isn't it?
It absolutely is. That's where the potential for sustained value creation lies.
So for you, the listener, the key things to watch going forward would be
Thank
that Q1 organic sales trend. Does it hold up?
Definitely. Plus further evidence of Hydradyne synergies flowing through, seeing that pricing ramp materialize in the numbers. And of course, any signs of a broader industrial demand recovery, especially in those automation-related areas.
And ultimately, hitting or beating their EPS and margin guidance will be crucial to validate this strategic pivot in the market's eyes. They need to show the plan is working.
Exactly. Proof points are needed.
Okay, now let's transition to our final segment. Please remember, everyone, this is absolutely not financial advice. It's just a thought experiment, an outrageous but plausible trade idea for you to consider.
Right, just kicking around some ideas based on the narrative.
We're calling this one the secular shift multi-legged play on applied industrial technologies.
Intriguing name.
So the setup is what we've discussed. Market reaction focused on cautious guidance and near-term noise, while management is signaling this big strategic pivot towards being a technical solutions partner, targeting growth in data centers, semis, automation, especially via ES and deals like Hydradyne. And they expect a stronger second half of fiscal 26.
Okay, makes sense. So what's the play?
The idea is a multi-leg strategy. Leg one, go long AIT, perhaps using out-of-the-money call options that expire sometime in mid-2026.
So buying the right to buy AIT shares at a higher price later on, a leverage bet on upside.
Exactly. It expresses confidence in that second half FY26 recovery narrative, the idea that the AR and LIFO noise fades and those high-growth tech verticals keep accelerating. You're basically betting the market is currently undervaluing this strategic shift because of the near-term caution.
Okay, that's leg one. Betting on AIT's specific story. What's leg two?
Leg two is designed as a partial hedge and a relative value component. Simultaneously, you could initiate a smaller short position or maybe buy some put options on a different industrial distributor, specifically one that's more legacy, less diversified, and crucially, doesn't have such a clear, articulated pivot towards high-tech and automation.
Ah, okay. So you're betting against a company that might be left behind if AIT's strategy works or if the broader traditional MRO market stays weak.
Precisely. It hedges slightly against a prolonged industrial slowdown that hits everyone except maybe AIT's specific growth niches, and it lets you capitalize on the potential underperformance of the more traditional players if AIT's differentiation strategy really starts to pay off and they pull away from the pack.
So the expected outcome is, if AIT executes, the macro stabilizes a bit in their key areas, those long AIT calls could generate significant returns. And the short position on the legacy player either provides a hedge if things stay tough overall, or adds to gains if AIT outperforms its more traditional peers. It's a bet on AIT's specific chess moves, as you put it earlier.
Exactly. A relative value play, focusing on AIT's specific transformation within a challenging sector. Again, purely a thought experiment, not advice.
Absolutely not advice, but an interesting way to think about the dynamics.
So wrapping up our deep dive today, AIT delivered a strong Q4, showed operational strength, record cash generation.
But chose a prudent path for FY26 guidance given the macro uncertainties.
And the market's initial reaction really underscored that tension between good past results and cautious future outlook.
Right. But at the end of the day, the story for AIT isn't just these quarterly numbers. It's about this deliberate, strategic evolution into a technical solutions partner, betting on those high-growth automation areas using disciplined capital deployment. That's the long-term value driver they're aiming for.
As always, this deep dive is purely for informational purposes. It is not financial advice. We really encourage you, though, to think about how these kinds of strategic shifts might be playing out elsewhere. What does AIT's transformation maybe tell us about other players in the industrial sector or even other industries facing similar disruptions?
That's a great takeaway question. Are other companies making similar pivots, maybe less visibly? Where else might traditional models be disrupted by these tech and automation trends? Something to definitely keep an eye on.
Thank you for tuning into the deep dive. We look forward to our next deep dive with you.